Hello everyone. Today we focus on new lecture. We mostly focus on the interest rate and money market. Okay, let's get started. In previous weeks, we tried to understand the creation of money, derivation of money, and other things. Today we come to a new topic. We try to understand the concept of interest. Also, these interests are occur in market in various ways or various forms. We try to understand the meaning of money demand and their determinants. After looking at the money demand, we focus on the money supply part. Maybe you can remember from the previous term, demand and supply. When we look at the demand and supply, we try to find the equilibrium. Also, we focus on this term. Today, we look at the money demand and money supply. It's look like demand and supply. After looking at the money demand and money supply, we see the equilibrium by the intersection point of money demand and money supply. That is called equilibrium interest rate. Okay, today we focus on many definitions. That's why I wrote all the things over here for you studying easily. Okay, let's start with the definition of interest rates. The interest rates is really important variable in macroeconomics because it's really highly affect our investment level, consumption level, or saving level, and mostly they affect our income in our country. We try to understand the mechanism of how the changes of interest rate can affect our consumption, saving, investment, or income level. For this lecture, we try to understand that mechanism. Also, we already talked about the equilibrium interest rate. As I said before, that is the intersection point of money demand and money supply. And there is an actor for in determination of equilibrium interest rate that is called central bank, the main actor for determining the equilibrium interest rate. We try to understand how central bank achieve for determining the equilibrium interest rate. Okay, we start with the concept. In economy or in life, everything has a use value. For example, you have a house, and or if somebody used your house, what they give to you, they give rent for using that house. That is the use value of using that house. That is the same process for the money. If someone use your money, this time they pay not rent, that is called interest. And today we focus on the interest part. Okay, let's try to understand the real definition of interest. In Turkish, that is faiz. Interest is the cost of borrowing money or compensation earned from the lending money. I think most of you use the bank, most of you have a bank account. I think you borrow a money or lend money from your friend. In this process, you mostly see the interest rate over here or other things that can show the cost of borrowing, okay? And that definition give the understanding easily the interest. When we focus on the interest part, the two basic concepts is related for the interest. The first one is interest rate and maturity. The second one is maturity. For example, when we put our money into your bank account in previous week, we called that process is deposit. When we open the deposit account, we looked at the interest rate and maturity, okay? Maybe you already remembered that process. Okay, let's look the legal definition of interest rate. You see over there, that is the interest rate. Rate means percentage. It is the interest rate is the percentage charged or earned on borrowed or lent money over a period of time. Okay. And maturity in Turkish vade. It is the repayment period or date of the debt received. Okay, when we open the deposit account in a bank, firstly we look at the interest rate and then we'll look at the maturity. And mostly, maybe this preferences is different for you. Maybe you firstly look at the maturity part, then you can look at the interest rate part. It's up to you. It doesn't matter. But there are many maturity periods in bank accounts, and that difference maturity gives different interest rates. You can check on your bank account by opening the deposit account or loan account or credit. Okay, let's try to understand the mechanism easily for looking at example. For example, you got a loan 5,000 Turkish lira from the bank, and at the end of period, and that period is 1 year, the bank demand for payment or repayment 5,500 Turkish lira. You got 5,000 Turkish lira, and the repayment is 5,500. So the difference between over here is 5,500 minus 5,000. So we paid 500 Turkish lira more, and that is called interest. Okay. So how can we calculate the interest rate? We know the loan maturity is 1 year. That's why the interest rate is 10%. How can I calculate it? I can write over here. This is the 500 Turkish lira to be paid back to interest. We can divide interest to a loan amount, 5,000. So that give the 0.1. Sorry for that. That is 1. And this is 10%. Okay. You see over there, we can delete that part. Okay, 1 divided 10 is 10%. This is the interest rate. Also, we can multiply 100. So the answer is 10. Okay. 0.1 also is the 10%. But I always said that when you see the rate, we can multiply the 100. How can we talk about interest in the monetary terms? Okay, let's get our laser again. Interest in monetary terms is look like the postpone our spending of today, okay? Let's give example for understand easily. But before looking at example, for example, you give a money to your friend. That means that you postpone your payment of today. So there is some process over here, and there's an opportunity cost. What's the opportunity cost over here? You pay your money to your friend and you give up that amount for buying something. So I think you deserve to demand an interest for that amount to your friend, but it's up to you. Okay, let's look at our example. For example, not looking at the friend's example. For example, you go to a bank and lend money from the bank. Is it not a zero interest money? No, because we use the bank money. So there's an opportunity cost over here. We can use bank's money. That means that the banks give up their money and they give up their investments or other things. So they have to demand some interest or more money to us. That is called interest process in the monetary terms. Okay, let's look again. By lending money without using the money itself, the bank give up today's various investment opportunities and the returns on these investments. So if the bank give money to us, they give up their investment opportunities and returns on these investments. That's why the bank charges to interest to us for using that money. Okay. So how can we calculate interest rates? We can calculate in two ways. Again, nominal interest rates. Maybe you can remember from your midterm exam. Nominal GDP and real GDP example or question. Is the idea is the same. In nominal GDP, we can use the current price and current quantity. That cannot eliminate the price effect or inflation effect. But in real GDP, we are fixing the price by using the base year, and they can eliminate the price effect or inflation effect. So it's look like the same, but let's look the definition of two. We can denote it nominal interest rate with sorry, in Turkish E. Let's look at the definition, then we can talk about it. The nominal interest rate is the stated rate of interest on loan or investment without considering the inflation. For example, we open a deposit account with 30% of interest rate. That is the nominal interest rate. What about the real interest rate, denoted R? The nominal interest rate adjusted for inflation. We can eliminate the inflation effect, representing the true cost of borrowing or true return on the investment. What does it mean? Okay, let's look at it. I said, for example, you open a discount account with 30%. We think that that's a really good percentage for us, but there's a reality over here. For example, in Turkey, let's assume that the inflation rate or inflation expectation is 50%. So the real interest rate is that amount minus that amount is minus 20. That's why in Turkey, a few people put their money into the deposit account, because you see your purchasing power become lower by putting on discount account. Okay, let's keep going. Then I put my laser again. I'm not gonna ask in final for that slide, only that slide, but we can look at for real interest rate in two terms, long term and short term. By looking to long term, the real interest rate determined by the rental rate of capital. This is the price of capital, it looked like. And that show the price used to produce on 1 unit of capital in production. But that's only detail for economic students. But the short-term period is important. Maybe I'm gonna ask a question in your final. In the short run, the real interest rates are closely related to the expected inflation in the economy. Expected inflation means, or in Turkish, beklenen enflasyon. Or that is means what you expect from next year or next term. It's determined by how can you look at it. And the central bank give or try to give some number about expected inflation, but in Turkey, never guess truly for expected inflation in real terms. We use an equation for calculating the real inflation in the short run. The equation comes from the Irving-Fisher. Okay. That equation is very easy equation, but I'm gonna maybe ask a question by using that equation. Let's look at it. How can we calculate real interest rate? That is equal to nominal interest rate minus expected inflation rate. It's like the previous example. So firstly, we look at the nominal interest rate minus expected inflation rate. So that is the smaller number or smaller rate rather than the nominal interest rate. That fact called a Fisher effect. the nominal interest rate is higher than the real interest rate due to the inflation. Okay? Because in real interest rate, we can eliminate the inflation effect. But in nominal interest rate, we cannot eliminate the price or inflation effect. So mostly the nominal interest rate is greater than the real interest rate. What can I say mostly? Because maybe in some countries, not Turkey, the expected inflation rate is negative, deflation. Okay. How can I ask in exam that you can see over here? Maybe I can give the nominal interest rate. Maybe I can give the expected inflation rate. Then you can calculate the real interest rate. So nominal interest rate is 12%. Expected inflation rate is 4%. So 12 minus 4, that is 8% for real interest rate. I can ask in various ways. There's an offer or to you. If you borrow or lending money, please take into account for real interest rate rather than nominal interest rate. Okay. You should lose this if you just look at the nominal interest rate. Okay, let's come to the new part. We can focus on the nominal and real interest rate. This time, we can focus on the bonds and bonds interest rates. If you get money or give money from a smaller account, there is no problem on it. But when the amount to be borrowed become the higher part, we need a more advanced instruments like securities. Okay. Let's give the definition of security, then we can talk about on the security. I have a cat. He tried to open the door. Sorry about it. Maybe you cannot heard it. Okay, let's look at the definition of security. The general name of financial assets issued by large companies and institutions that can be bought and sold. I can tell again because I'm a little bit confused about that noise. Security in Turkish menkul kıymet. That's the financial assets that issued by large companies, large institutes, or also government issued securities that can bought and sold. That is the way of creating money process. For example, you can see over here, when governments, public institutions, banks, and large companies needs to borrow large amounts of money, they issue bonds and bills, okay? Mostly governments, when they give budget deficit and they try to find a money, they issue debt, bonds and bills for cover their budget deficit, okay? That is the example of treasury bill for the USA. Okay, let's look at the definition of bonds. In previous slide, I said the governments and other actors issued bonds and bills for creating or finding money. Let's look at the definition of bonds. Bonds are also securities with maturity of 1 year or more, okay? 1 year more or more detail give the name of bonds, and that is the securities that issued by an entity promises to make a specific payment at the end of the term. For example, when you buy a bonds, you know how can you pay it to you. That's the specific payment at the end of the terms. And bonds cover 1 year or more period, okay? Bills are the same, but the period is the different. This time, the maturity is less than 1 year. For bonds and bills, there are some components over here. Maturity. For bonds, 1 year or more. For bills, less than 1 year, maybe 1 month, 3 months, or 6 months. Also, we focus on face value. And sometimes, but we cannot focus on the coupon rate. But we mostly focus on the face value. Okay. So what's the definition of face value? That is the amount. First, we look at the real definition, then we can talk on it. The amount that will be paid to the person who will hold the bond at the end of maturity. For example, you buy a bonds with paying 100 Turkish lira and their face value is 120 for 1 year later. If 1 year later pass, then you give that bill or bonds more than 1 year, you get 120. That amount is called face value, okay? At the end of maturity, the amount we will take is called face value. We cannot focus on the coupon part, but let's look at the definition. I can take the laser again. That is the fixed payment to the made irregular intervals to the bond holder. Okay. I know you can already know the coupon part, but when we add the coupon to our example, the questions becomes harder. That's why we can focus on the non-coupon bond or non-coupon bills or no coupon. Maybe non-coupon is more appropriate. And no, okay, I write over here no coupon. We can follow in that sense. The no coupon bonds are usually offered at sale at discount, okay? That means that their price always change the conditions of the market. Okay, let's come to a new formula. How can we calculate the interest of bonds? The bond interest formula is equal to face value minus bond price. In our previous example, I said we can buy bond 100 and face value is 120. So 120 minus 100 give bond interest 20. If we buy that bond price to the more discounted, our bond yield or bond interest become higher. And I said the bond price always change the conditions of the market. So that not is a fixed value for bond price. When the bond price changes, the bond interest rates also changes definitely. So that is the second formula of in the topic of bonds. The bond interest rate is equal to bond interest divided bond price multiply 100. Okay, let's look at an example for understanding easily. I can write our formula over again. Okay, let's assume that we buy a bond, 1 year maturity, and the face value is 1000 Turkish lira. The face value is at the end of maturity, what can we get for buying that bond? And the selling price of that bond is 800 Turkish lira. So that means that we pay 800 Turkish lira, and 1 year later we get 1000 Turkish lira. Okay, let's calculate bond interest and bond interest rate. We pay 800 Turkish lira and we get 1000 Turkish lira. So the bond interest is, the face value is 1000 Turkish lira. I can use a pen. And the bond price is 800. So 1000 minus 800 is 200 interest income will be earned. And the second question is, how can we calculate the bond interest? That is the bond interest divided bond price. So the interest is 200 and bond price is 800 multiply 100. So the bond interest rate is 25%. And I said already, the bond price is not a fixed. They can change the conditions of the market by the changes of money demand and money supply. Let's make another example, or let's use the same example in different portion. For example, the bond price change 800 to 870, but the face value is the same. Let's calculate again bond interest and bond interest rate. This time we pay 870 and our face value is 1000. So the bond interest is 130. So our interest become lower rather than the previous example. What about the bond interest rate? Bond interest is 130 divided bond price. Bond price is that amount. Multiply 100. So the interest become lower also. It's 15%. In previous example, that is 25% over here. Okay. Let's assume that if the bond price become higher, the interest rate become lower, like that example. And also vice versa. When the bond price become lower, the interest rate become higher. Okay? That's the rule. Okay, let's come to a new topic, various interest rates in the economy. We cannot focus on all interest rates in the economy, but we try to catch some of them. I can get my laser again. We can start with, you can see that is the government and bond. Let's start with the government bond. That is called government debt security. That is the general name for the bonds and bills issued by governments. That based on the law, definitely. And why government issued that government debt security or debt bonds? They try to cover their budget deficit. You know, in the election time, the government use their resources, so their budget deficit position become higher. So the way of covering budget deficit, one of the way is government issued government debt security. And that mechanism not only appropriate for the Turkey, we can see a whole world in election times. These securities the government debt securities are mostly issued by the government, I said, but more specifically, Treasury and Finance Ministry of Government. In Turkey, the Treasury and Finance Ministry issued that government debt security. And I forget to say in Turkish, but I want to say in Turkish, government debt security. Devlet iç borçlanma senetleri, DIPS. Okay? In English, government debt security. That government debt security have many majorities, like you can see over here, 3 months, 1 year, 5 years, or 10 years, okay? So the question is over here. What's your demand? What can you choose? 3 months, 1 year, 5 years, and 10 years. Myself mostly focus on 3 months or 1 year. If you choose 10 years, you get more gain. But you know, I can say the answer. If you choose the 10 years, you are not guess the future. It's really hard. Rather than the 3 months. For guessing the 3 months also, it's a hard thing. But guessing the 10 years later, it's more hard. So there are some uncertainties about the future. That's why the people do not demand the long-term securities. Okay, their demand of long-term securities become lower. That's why. I said government issued that government debt securities, but that is not the only security. Other actors also issued some bonds and securities. For example, the private banks and companies issued a bonds that is called corporate bond, and they can use the rate of corporate bond rate. But there's a problem over here. Let's look at the definition of credit risk, then we can talk about the government and private part. The risk of non-repayment of a given debt is called credit risk. There is a two choice for you. You can choose a government bond or you can choose the private bond. But it's definitely the private bonds include some credit risk rather than the government bonds. How can private bonds or private bank bonds eliminate that credit risk? There is no way for eliminate for credit risk for now, but they can use a way for eliminate your choice. If you give higher yield or higher gain to rather than the government bond, you may choose that private bonds for getting higher yield, okay? For that time, you cannot see that credit risk. But don't forget, that's include the credit risk. So My personality don't like a risk. That's why I mostly choose the government bond. But if you like a risk and like a high gain or high yield, you can choose the corporate bonds. It's up to you. It's related with your personality. So in private bonds, how can they determine the rate of interest? They look at the government bond rate. They try to give higher interest rate rather than the government rate. That government interest rate, mostly called, you can see over here, benchmark interest rate. Let's look at the benchmark interest rate definition. That is the lowest interest rate that investors would demand for a non-government security. So if we decide to buy private bonds, we expect that bond interest rate is higher than the government bond interest rate, and that government bond interest rate percentage is called benchmark interest rate. In Turkish, gösterge faiz. And also that benchmark interest rate reference for not only that process, that also give reference to the many transactions in the bond or money market, okay? We focus on the benchmark interest rate, and I said there are various interest rates in the economy. You know that part, discount credits. I said the deposit, that benchmark, and let's come to the discount credit. Okay, let's focus on. In previous week, I said the central bank give money to the banks. That is called discount credits. Let's look at the legal definition of discount credit. It is the credit that commercial banks receive from the central bank against the securities they hold. Who's gonna decide the discount credit rate? And also that is called not discount credit rate. Discount rate is more appropriate. That can decide by the central bank for using the discount transactions. And also another way, and another interest rate in the economy, banks able to get money from central bank, also banks able to get money from other banks. And in that process, they use an interest rate, and that is called in Turkey, for example, or other countries, IBOR, interbank offered rate. What's the IBOR? It is the interest rate at which banks offer to lend unsecured funds to the other banks in money markets on a daily basis. And that IBOR come from the LIBOR. That L come from the London interbank offered rate. And mostly they focus on the LIBOR. But if we that LIBOR percentage used in London, that's called LIBOR. For other countries, that's called IBOR. The interbank offered rate. You can maybe easily from the name of the interbank. The banks give their money to the other banks. And the rate of is called IBOR or LIBOR. In Turkey, IBOR. In London, LIBOR. But IBOR comes from the LIBOR, don't forget. Okay, we already talked about LIBOR. Another rate is in the economy is deposit rate. You already know, and I think you can use in your real life. That is the interest rate that banks offer on the deposit they collect. I'm not sure, but my bank offer a 30% for me for 1 month. But I know the inflation is more than that percentage. So it's not a good choice for me. But it's up to you. It's your choice. Okay, let's come to the new part. We can look at the various interest rate, but how can we determine in money market for the interest rate? Again, we can come to the John Maynard Keynes. You can see his book, The General Theory of Employment, Interest and Money. In the semester, we already focus on employment part, money part, and today we focus on the interest part. He is very important in our macroeconomy. Okay. As I said before, Keynes tried to understand the behavior of human and behavior of human in the economic transactions. And he finds many things for like consumption theory. And also you can see over here the liquidity preferences theory of interest and theory of assets demand. Last two theories, these two theories, try to give meaning of how can we determine the interest rate. He focused on the money demand part and money supply part, and he said the intersection point of money demand and money supply give the equilibrium interest rate. And in the money market, we can use that percentage, okay? We focus on detail in other slides. Okay, Keynes said money demand and money supply. Let's focus on the money demand part and money supply part. Money demand, MD. Let's look at the definition. But before looking at the legal definition, I'm gonna give my example. Again, you can remember my lecture. If I put that money into my pocket, that is the money demand process, okay? Let's look at the legal definition. It is the total amount of wealth that all economic units in the economy want to hold in a form of money based on prevailing interest rate during the given period, okay? Economic units do not consume money itself. How can we consume it? We demand money for some reasons, like we purchase some goods and services, we make saving, we make investment or other things. And mostly in Turkey, I'm sure you already paid your taxes. Also the example of how can we use money for demanding. So there is an important questions over here. If I put money into my pocket, okay, that is the 10 Turkish lira you see. If I put 10 Turkish lira in my pocket and open 1 year later, okay, 1 year later, again 10 Turkish lira. So there is no gain for putting our money into your pocket. Rather than if I put that 10 Turkish lira to the for buying a financial instruments, I'm not definitely, mostly I try to gain some money. If I put that 10 Turkish lira, maybe 100 Turkish lira to the bank, that is the deposit account, I get some interest rate. But if I put that money into my pocket, I give up for getting that financial instrument gain. Okay. But there's a questions can occur over here. Why can I put that money into my pocket? The Keynesians try to understand that mechanism why people put money into their pocket or why people demand money. They pointed that there are 3 reasons. And I'm not sure, but I'm gonna ask why people hold money in your final exam. And there are 3 reasons. The first one is transaction motive. In Turkish, işlem güdüsü. The second one is precautionary motive. In Turkish, ihtiyat güdüsü or önlem güdüsü. And the third one is speculation motive. You already know the Turkish. The same. Okay, let's look at the detail about transaction motive, precautionary motive, and speculation motive. Let's start with transaction motive. We demand money. The first mainly reason is for making our daily transaction. We go to outside, we buy coffee or other things, goods and services. We mostly pay for a cash. That's why we need the money for that, doing that transaction. And that's called transaction motive. And there's a rule over here. If the general price, personal income, or daily transaction volume increase, our transaction motive become higher. I can say again, if our income, that means real GDP, our price level in the Turkey or your country, also our daily transaction increase can affect the increase of transaction motive. Or if the general price become down or your income or real GDP become down, your transaction motive become lower. You demand less money rather than the previous condition. Okay, let's look at the precautionary motive. In Turkish, önlem güdüsü or ihtiyat güdüsü. Okay, let's look at the legal definition. It is the demand for money that arises from the desire to be prepared for future emergencies. We can demand for money for prepared for future emergencies. That may be a good thing or bad thing. Mostly we prepared for future emergencies for the bad thing. Let's look at the detail. Maybe accidents, illness, or unemployment, or maybe a good thing. opportunities for advantage purchases. Okay. When general price level, income, or economic uncertainties increase, our precautionary motive also become increased, or vice versa. If the general price, income, or uncertainties become low, the precautionary motive for demand money become low. Okay. And the third one is speculation motive. You already know the meaning of speculation. But let's look at the more formal definition. It is the motive for holding money based on the expectation of future price changes in financial or non-financial assets that may result in gain. That is not important, but let's remember that money is a medium of exchange that has purchasing power. Okay, for example, you have a bond and you expect that the bond price become lower tomorrow. What you do? I think you should sell that bond today, and because you know the process, it become lower for tomorrow. And when we come to the tomorrow, you can buy again for bond. Then you have more bonds for that process. That process called is speculation. Okay, I can tell the speculation motive also. Let's come to the money demand curve. Before coming to money demand curve, let's again focus on previous term, the demand and supply. In demand and supply, we see that in the vertical line, we use price. In horizontal line, we use quantity. But today we talk about the money part. The quantity become money quantity, the amount of money. But what can we put for rather than price? Let's come to our part. In vertical axis, this time we cannot use price. For using that money, we can put interest for the vertical line or interest rate. Okay, let's give more detail. And we assume that there's only one, for become easy for understanding. There's only one nominal interest rate, and we can denote it with I. But I said before, in your real life, you always look at the real interest rate by making your true investment. If we need financial resources, we can borrow and pay interest in return. I can look to the important parts over here. I'm sorry. If we need the financial resources, we can borrow and pay interest in return. And if I have a surplus in your pocket or wallet, not pocket, I always pocket. That is wallet. Sorry about it. How can we use that surplus? We can invest or we can invest a bond or put our money into bank. It's up to you. Or just put our wallet. But if I put our money to our pocket, we give up for getting that financial instrument gain. So it's obvious that for putting our money into our wallet, we give up for a gain. So there is an opportunity cost of holding money, which is equal to the foregone of interest rate. Sorry about it. So that means that if I put our money into our wallet, we cannot get that interest. So we give up for that interest rate. That's our opportunity cost for holding money. So the higher interest rate means that the higher opportunity cost for holding cash. So there is an investment opportunity over here, but you cannot pay that amount to that investment opportunities. Rather, you put your money into your wallet. So the opportunity cost become higher. But in rational consumer, when the interest rate increases, the quantity of money demanded decreases. So you can see over here the negative relationship. When the interest rates become higher, the quantity of money demanded decreases. And vice versa. When the interest rate become lower, at that time people may prefer to hold more cash instead of investing in bonds. So let's summarize. If interest rate become higher, the opportunity cost of holding money become increase. That's why the people money demand level become lower. When in the second condition, when the interest rate become lower, the opportunity cost of holding money become low. That's why money demand become higher. So how can we draw the money demand curve? You can see over that easy example or easy table. When the interest rate become higher, the money demand become lower, or look at that sense, when the interest rate become lower, the money demand become higher. So there is a negative relationship between interest rate and money demand. So it's looked like that. As I said before, in vertical line, we use nominal interest rate. And in horizontal line, the quantity of money. Let's look at more formal definition of money demand curve. You see that's the graphical tool, and that shows the relationship between interest rate, nominal interest rate, and the money amount. Money economics units want to hold more legal, and the other things held constant. Okay. Okay, let's come to the new part. That means that ceteris paribus. Okay, maybe you can remember in previous lectures. Huh. I forget something, that's why I'm thinking. When the interest rate changes, like at that point, the interest rate is 8. For example, if the interest rate change 8 to 6, we can move along the money demand curve. Okay, we cannot shift it. We can move along the demand curve. That is called a change in quantity demanded, that process. We move along the money demand curve. And there are some other factors for determining the demand for money. If interest rate changes, we can move along the demand curve. But if other factors can change, we can shift to the right or shift to the left. Okay. Then that shift called a change in demand. When we move along to money demand, that process called a change in the quantity demanded. But if a shift for right or left, that is called a change in demand. That is demanded, that is demand. Let's look at the other factors. When we fix to the interest rate, the first factors for affect the demand for money or money demand. The first factor is real GDP. The change in real GDP can affect the money demand. The second one is the price level or general price level. We can talk about already in previous slides. And the other factors, the technology level, our expectation about future, and institutional factors. Okay, let's look at it. My cat tried to open the door, but he cannot achieve it. Okay, let's look at the first after the. Okay, let's wait a second. I'm gonna open it. He makes some noise. Komik kedi. Okay, let's look at the second factors for determination of money, or the first factor for shifting money demand or demand for money. This is the same thing. When our income become higher, we make more transaction for buying or selling goods and services. That's why when our real GDP increases, our money demand increases. That means that our money demand shifting to the right, okay? And vice versa. When our real GDP become lower, our money demand become lower because our transaction level become lower. That means that our money demand curve shifts to the left. In previous slides, we can talk about the interest rate. When the interest rate changes, we can move along to money demand curve. But this time, for example, the real GDP changes, we can shift to the right or to the left for the money demand. The second factor is for shifting is prices or general prices. If the general price become higher, we need to hold more money for buying that goods and services. That's why when the general price is higher, the money demand become higher. That's why the money demand shifts to the right. When not in Turkey, when the general prices become lower, we need to hold less money for buying that goods and services. That's why the transaction motive become lower. That's why the money demand become lower. And also in that sense, money demand shift to the left. Okay. Let's look at the other factors. For example, I said technology, uncertainties, and other things. Technology is mostly the financial innovation. In Turkey, we see many financial innovations that can reduce our demand for money. Like that innovation is internet banking, automatic payment, ability to transfer from time deposit, or other things. And also you use the credit cards. That innovation give opportunity to use, we can use less money for doing our business. That's why the technological or in financial innovation become higher, our money demand become lower. Okay. But for example, if uncertainties become higher in some countries, we can increase our money demand. That means that money demand shift to the right, because in uncertainties time, we try to increase our precautionary motive for holding money. Okay. That is the money demand curve. If money demand curve shift to the left, it's look like that. If money demand curve shift to the right, it's like that. So that is the degrees of money demand. That is the increase of money demand. Again, in vertical line, nominal interest rate and the money amount or money supply or quantity of money. Not money supply, sorry for that. The quantity of money is more appropriate. Okay, let's come to the, after look at the money demand, we come to the money supply part. We can use MS for money supply. You already know the meaning of money supply. In previous week, we focused on the detail of money supply. But let's look again in different ways. Let's look at the definition. The money supply is the total amount of wealth in the form of money created by central bank, commercial banks, and non-bank entities during the specific period. We already focused on how can we create a money in the banking system or central bank. But mostly the main actor is central bank, mostly, definitely. So the money supply amount cannot, how can I say, sorry about it, I need a water. The money supply amount cannot affect the changes of interest rate. That's why the shape is like that. It's like perfectly inelastic shape, like insulin example in previous term. Let's look at the meaning of supply curve that show the relationship between nominal interest rate and quantity of money in the economy when other variables are constant. But you see, the changes of interest rate cannot affect the amount of money supply. The central bank mostly control the mechanism of money supply, and they can affect the money creation process in banking system also. In other slides, we try to understand how can central bank control the money supply mechanism and how can try to control the interest rate in the market. As I already said, the money supply is not affected by the interest rate. I already said the central bank mostly control and manage the money supply, and they can use some instruments for doing that job. We focus on 3 of them. I'm also gonna try to ask in final. The first one is open market operation. In Turkish, açık piyasa işlemleri. The second one is discount rate. In Turkish, reeskont oranı. And you already know, required reserve ratio. In Turkish, zorunlu karşılık oranı. Okay, let's look at the detail about it. Let's look at the open market operation. OMO. OMO is the buying and selling of the government securities by central bank in the money market. So there's a OMO buying or OMO selling, okay? Let's think about it. Let's start with the selling. If the central bank sell to me securities, I buy that securities and I give money to central bank. So the amount of money in the market become lower. Or other things, if I buy that government securities, I get that like that securities. Okay, I start again. Maybe I can tell wrong, I'm not sure. Let's start with the buying part. Or I can show in detail. It's more easy to understand. For example, open market operation buying. Okay, let's start. If I buy that open market operation, if I buy government securities, I give money to, I'm not sure, but maybe I'm gonna tell wrong. Let's give a second to me. Okay. There is no wrong about it, but I'm become confused about that process. The open market operation buying is not my buying. Sorry about it. That means that the central bank buying process, they collect that securities, okay? If they collect their government securities or government bonds, they give money to us, or not only me, also the bank or other actors. So the reserve of the bank become higher. So they are able to give more loan. If they able to give more loan, the personal deposits become higher. So in the money supply amount become higher. So the important thing is over here. When the open market operation buying achieve, the money supply become higher, okay? I said again, the open market operation buying means that the central bank collect the government securities and they give money to the market. That's why when open markets operation buying can achieve, the money supply become higher. Let's come to the open market selling. If they sell to government securities, this time they collect the money. So the amount of money become lower. So money supply become low. How can they proceed it? The reserve become low, the loan become low, also deposit become low, and at the end, when the open selling can achieve, the money supply become lower. Okay, that's the first one, the open market operation. Let's come to the discount rate. In Turkish, as I said before, reskont oranı. The rate of interest charged by the central bank to the commercial bank is called the discount rate. As I said before, the central bank give money to the banks, and this is called discount credit. And in that discount credit mechanism, they use the discount rate. If the discount rate become lower, that means that the banks can easily get money from central banks. So at that condition, the reserve, the loan, and the deposit become higher. So when the discount rate become low, the cost of borrowing condition for the bank become low. For that reason, in the market, the money supply become higher. Okay, but there is a negative relationship. When discount rate lower, that can achieved for increase in money supply. When discount rate become higher, that means that the cost of borrowing for banks become higher. So their reserve level become low, their loan and deposit level become low. In that sense, the money supply amount also become lower. So when the discount rate increased, the money supply become lower because the cost of borrowing for the bank become higher. Okay, let's come to the required reserve ratio. We already did that required reserve ratio in previous week. But again, let's look at the definition. It is the money that the bank is obligated to keep in its safe or the central bank account, depending on the amount of deposit has collected. I said, if somebody put their money into bank in deposit account, the bank used that money for giving loan to the other people or other personalities or other institutions. But at that time, they are not able to give a whole money to the loan. There is some restrictions that came from the central bank. The central bank said you can uh, you have to obligate to hold some amount for that deposit, and that come from the required reserve ratio. So maybe you can remember the formula of required reserve. Required reserve equal to deposit multiply required reserve ratio. Okay. You can check in the previous slides. So when required reserve ratio become lower, that means that the banks hold less required reserve. So the excess reserve part become higher. So they are able to give more loan to other actors in the money market. So also for that reason, the deposit become higher. So the money supply become higher. So when the required reserve ratio become lower, the money supply become higher. That's the results. Again, you see the negative relationship. So when I forget to write it down. When required reserve ratio become higher, that time the bank have to hold more required reserve. That's why the excess reserve part become lower. That's why the banks give less loan to other actors. So the deposits become also lower. So the money supply level become lower. If you see when the required reserve ratio become higher, the money supply become lower. So that is the shape of a decrease in money supply. That is the shape of increase in money supply. The decrease in money supply also called shift to the left, the decrease part, and increase part, the money supply shifts to the right. Okay. Okay. Let's come to the end of the story. We focused on the money demand, then we focused on the money supply. Let's come to the equilibrium part. In previous slides, that part is also important. So don't skip it. You already know the meaning of money market, but let's look at the more formal definition. It's a physical or virtual environment where the short-term securities such as treasury bills are bought and sold, and where interest rates are determined in that process. So the interest rate determined in the money markets. So also that is called equilibrium interest rates. So let's look at the money market equilibrium. You already know where is the money market can achieve. Sorry, I'm gonna open again the door because of my, maybe you can see over here, my head. Sorry about it. So the intersection point of money demand and money supply can give the equilibrium condition. That is called equilibrium interest rate and equilibrium money amount. We cannot, the money market cannot change the money supply, so we can also say money supply, but the interest rate is changeable. We can look at the process it. So the equilibrium condition is money demand and money supply equality. The intersection point of money demand and the money supply give the equilibrium. So that is the money supply curve. That is the money demand curve. The intersection point of money supply and money demand curve give the equilibrium interest rate. You can see that is the money supply. Some books also called equilibrium money supply amount. Okay. So at that point, the intersection point, as I said, give the equilibrium interest rate that can determine the borrowing or lending condition of transaction in money market, and that is called equilibrium interest rate. That part is important. Let's look at it. Firstly, I can write over here. Where's the first intersection point? This is MS is our first curve, and MD is our first curve. The intersection point of money supply and money demand, that point, is our first equilibrium point. At that point, the interest rate is 7. Okay, and the money amount is 160. Let's assume that the money supply become lower, or the money supply curve demand to the, you see, left. So where is our new intersection point? Is there any change in money demand? No, but there is a change in money supply. So our new intersection point is over here. So this is the second point. So the money supply become lower and the interest rate become higher. Okay. So I set the factors of the shifting part of the money supply. I said the three things. The first variable can affect the money supply changes. If regard to the ratio increased, what can I set? The money supply become lower. I can tell in previous slides, I can tell again. Okay. Please return for your study. Let's count again. So the question is, in which conditions the money supply become lower? If regard to the ratio higher, the money supply become lower. And you see when the money supply become lower, the interest rate become higher. Okay. So how can I ask in exam? For example, I said, if regard to the ratio become higher, what happened to the money supply or interest rate? Okay. Or I can return again. What happened to the excess reserve? If for example, that example, regard to the ratio become higher, what happened to the loan, deposit, or money supply? Okay. You can study detailed for that slides. Let's come to again. If regard to the ratio become higher, the money supply level become lower. When money supply level become to lower, our interest rate become 7 to the 7.5. So it become higher. Or another factors for money supply become lower. That is the discount rate. When the discount rate become higher, the cost of borrowing for bank become higher. That's why the money supply become lower. And when the money supply become lower or shift to the left, the interest rate become higher. Or another factor, open market selling. If central bank selling can achieve, the money supply become lower and the interest rate become higher. Okay. That means that I can tell again, if central bank sell their securities into the market, they get money from us, so the money supply become lower and the interest rate higher. you can see over here, when the money supply shift to the left, the interest rate for equilibrium become 1 over to the 2. Okay. What about the other part? If money supply become higher, that means that shift to right. Let's do it again. Where is our first equilibrium point? MS and MD. This is our first equilibrium point. At that point, the equilibrium interest rate is 7. What happened to money supply increase to the right? This time, MS1 and MD. This is our new intersection point. We see the interest rate become lower. So in which conditions money supply become higher or shifts to the right? Let's look at it. When Ricardo ratio become lower, the money supply become higher, and that's why the interest rate become lower. Or discount rate when discount rate become lower, the cost of borrowing for the banks become lower. That's why the money supply become higher and interest rate become lower. Or open market buying. When open market buying can achieve, the central bank gets securities from us and they give money to us. That's why the money supply become higher and interest rate become lower. And I think one more slide more, the money demand part. Okay, let's determine the intersection point. Where is the first intersection point? That one. In the first intersection point, the interest rate is 7. And when the money demand shift to the left, that means that decrease in money demand. There is no changes in money supply, but there is a change in money demand. So we can move 1 to the 2. So you see the interest rate become lower. So in how can we see that condition, the money demand shift to the left? Let's remember, when real GDP become lower, our money demand shift to the left. When money demand shift to the left, the interest rate become lower. So you see, when the real GDP become lower, the interest rate become lower. When the general prices become lower, the money demand become lower, the interest rate become lower. The direct relationship. If uncertainty is lower, the money demand lower and interest rate lower. Let's look at the other part. Where is the first point? It's over here. Oops, I cannot see. This is the first intersection point. You see over here. So when the money demand become higher, that means that shift to the right. That is the left. Our new intersection point is intersection of MD1 and MS1. Not MS0, sorry. There's no changes in money supply. So when the money demand become higher, you see the interest rate become higher. So in which sense the money demand shift to the right? When the real GDP become higher, the money demand become higher, and that can affect the increase in interest rates. And also increase in prices can affect the money demand increases that can achieve also focused on the or forced to the increase the interest rate. And if the uncertainties increase, many people hold money more in their wallets, so the money demand become higher, so the interest rate become higher. Okay. Okay, that's the last slides for today. Thanks for watching you. Sorry. Thanks for watching that video. Thanks for your attendance. And good luck on your exam. I'm gonna give more detail about exam in next week or this week. I said this week because of the time. And good luck on your exam again. And see you soon. Bye-bye.